As per their CEO, if there is one thing to do, it is to not invest in a fund that has been the best performer because it is likely to be the. These days, you get notified by many apps that crunch data that your portfolio of stocks or mutual funds have not been beating the Nifty 50 or a benchmark. These new age apps also suggest that you sell these funds that are not doing well, as in not delivering good returns. They also recommend which funds to invest in based on your age, your life stage situation, and other profiles. They then give you a list of funds which are likely different from what you are investing today. So I want to talk about this nudge about selling poor performing funds and then buying the ones that have done very well in the recent past. When I say poorly performing funds, I typically mean those funds that have not given good returns over the past 1 year or so, or where the returns are lesser than other peer group funds, or funds that have failed to beat the benchmark or index. And I will reveal one key point which might make one uncomfortable too. Well, this is my personal opinion based on my very personal experience in investing. Firstly, about exiting or redeeming the funds that are doing bad in terms of the recent 1 year or 3 year performance, and then buying the ones where the last 1 year return has been very good. Now, this is very easy. You just look up any reasonable website that aggregates this data. It'll tell you which funds are doing well. You can get hold of the fund stack ranking here. There is a wonderful research done by Whiteoak Capital. They have analyzed dozens of funds over the past many years to arrive at this lesser known truth. As per their CEO, if there is one thing to do, it is to not invest in a fund that has been the best performer because it is likely to be the worst performer in the next 3 years. The fund that is the worst performer in the past 1 year or 3 year basis, that will likely be the best performer in the next 3 years. There is a very high amount of recency bias amongst investors to only invest in funds that are top performing, best performing based on past 1 year or a 3 year return. So he says if you want to make use of past 1 year return data, find out the past 1 year best performing fund and do not invest in it. Do not give money to this fund. This he says based on the extensive research on what has happened over the past many years. This is the most important chart of this research presentation. Let me simplify this for you. Just look at the first two columns. The 3-year best performing fund between 2009 and 2011, identified as the number 1 ranked fund, ended up 162nd rank at the end of 2014 on a 3-year performance basis. If you had invested in the first 25 best funds based on the previous 3-year performance, where would you land in the next 3 years? That is indicated in this column. The rank 2 fund ended up 40th rank 3 years later. The 5th rank became 100th rank. There are some exceptions like here. The correlation of this rank between this period shown in column and these two periods is shown here. A correlation of 0.7 or above is considered good, but you will see that far from 0.7, they have negative correlation, which means if a fund was at the top, it will land up at the bottom 3 years later. Some places have zero correlation. Some places have negative correlation, low correlation. They have taken a variety of 3-year period. The highest correlation that it has come up to is not over 0.49. And the funds have done well between 2012 and 14. In 2015 to 17, they did not do that badly. Everywhere else, what it shows with evidence is that if a fund has been the best performer for 3 years, then in the next 3 years, this fund has not been able to do well. This fund is not going to be the top performer. In fact, they are likely to be in the bottom. You can write to me here if you want to get a copy of this research. So they write in their report, chasing recent performance leads to accidents. So why does this happen? It is because each style of fund management, broadly, this is how the fund managers invest. he is following either a growth style of investing or a value style of investing or quality, etc. Now, all these styles are cyclical. No one style remains at the top forever, as you can see. In 2018, quality was at the top. Then it went to the bottom. Value style has been underperforming for many years here. Now, this style is doing the best. As you expect, you see these funds are getting a huge inflow as investors are flocking to it now after it has become the top performing fund. But what happens to the money invested at the peak? In the next few years, value will also be cyclical and move down from the top. But in 2018 and 19, value was the worst performing fund, but no one was interested in this style. So funds never had inflows. Now, just as style rotates, sectors also rotate. For example, PSU banks were at the bottom then, now it is at the top. So when do you invest in these? When they are at the top of the performance or when they are at the bottom of the performance? IT was the best performing funds in 2021. But if you had invested based on the best performance then, today they are the worst performing. You would have made poor returns if you had invested based on best performing then. It is not possible to consistently time the winners, and there may be prolonged cycle of underperformance or overperformance of a fund. It is impossible to predict which sector or which style and hence which fund will do well in the future. In fact, 65% of the funds do not remain top performer after 1 year. So if an app nudges you or tells you your fund is underperforming for the past 1 year or for the past 3 years, please do give it a second thought. Remember the truth of correlation. A fund that is doing well is likely to go down in performance in the next 3 years. And a fund that is not doing very well is likely to do well in the next cycle. So if you have to do an SIP for 3 years, which is the fund that you will do SIP into? Please do share in the comment section. If you enjoyed the content of this video, please like it, share it, and subscribe to this channel. There is one truth that is not comfortable: the role of luck. This is very less spoken about, but if an investor is lucky, it is normal to attribute it to skill. But since market is a sum total of emotion, the role of luck is underplayed. So when you're prompted to act by an app or an AI-led pod, before acting, do give this quote a consideration.